Hi, everyone. I wanted to welcome you to our third big webinar on the FinTech frontier. We've got a fantastic turnout and very diverse set of participants. Some of you have been with us through each of the sessions, and others are joining us for the first time. Either way, we're really excited to engage all of you in all that's happening here in Cincinnati. I'll start by thanking, again, our founding partners, Western and Southern and Fifth Third Bank. Their leadership is a powerful example of the connections we can all make to open up doors to local startups and to encourage startups from outside the region to take a hard look at what's happening in Cincinnati. We'll get to the panel in a moment, but I want to provide a bit of a quick perspective to help frame the conversation for those of you who weren't with us in the first two sessions. Our purpose and mission here at Centrifuge on behalf of the entire ecosystem is to accelerate the growth of a tech-based economy in Cincinnati. The primary way we're doing this is by establishing Cincinnati as the #1 startup hub in the Midwest and one of the top innovation hubs in the country. We have so much to work with. A concentration of Fortune 500 companies eager to work with startups, an equally great concentration of world-class universities leading research and growing entrepreneurial talent, an ecosystem that's passionate and eager to support startups in every way they need. And I know this firsthand. I launched a startup right down the street, sold it to Nielsen. Never thought I'd do it in Cincinnati, but as a native Californian, I saw a huge opportunity here. And we also have a growing pipeline of startups that are putting Cincinnati on the startup and venture capital map. And obviously we want a lot more of that. And yet we're not where we need to be. Our startup pipeline is not big enough. We're not getting, when we're only getting a tiny fraction of the venture capital that's still flowing to the coast. And we are absolutely positively out to change that. One of the most important things we've done is to get crystal clear about where Cincinnati has a right to win. Those critical few mass areas where we have what it takes to accelerate growth and distinguish us from the coast and other regions, which is why we're here today, exploring the future of FinTech. In our first session, we focused on how FinTech is, players are pivoting in the age of COVID. The second session looked at how financial services is being transformed by tech, with particular emphasis on AI and machine learning. And today's session is going to explore ways that FinTech is making financial services more inclusive and available to everyone. Now, I'll let Matt and the panel take it from here, but I just want to underscore the power of the vision that we're calling the FinTech frontier. FinTech Frontier is a partnership between industry-leading financial services corporations based here in Cincinnati and FinTech-focused entrepreneurs, all powered by Centrifuge in our role as Cincinnati's catalyst and catalyst for startup innovation. It's designed to accelerate innovation that transforms every aspect of financial services, from consumer-facing experiences to back-office operations. And our vision is to create a launching pad for FinTech entrepreneurs. We want to attract people who see bold new ways, who can make financial services accessible and engaging to consumers from every walk of life. And we want to inspire entrepreneurs who see how technologies from AI to blockchain to IoT can make financial services more personal, private, accessible, and efficient for consumers, for business customers, and for financial services firms themselves. And we want to open up doors for founders whose great ideas need enterprise customers who can help them succeed and scale. And that's a really big opportunity we bring to the table here. We kind of like to think of our region when it comes to FinTech as the place where Main Street greets Wall Street to help create the future of finance. On that note, I'll turn it over to Matt Green, who leads M&A and strategic venture capital for Western and Southern Financial Group. Couldn't imagine a better moderator for this. Western and Southern are deeply committed to being a leader and catalyst for innovation. We're delighted to have Matt with us today. And thank you again for joining us. Matt, take over from here. Thanks for joining us.
Thanks, Pete. Certainly appreciate the kind words there. So this week, as Pete alluded to, we're going to take a look at how all this technology and disruption converging to create financial services and tools that are accessible to everyone, not just the wealthiest few. Fintech is creating a range of new financial services and options. It's enabling much more equitable access to financial advice and planning tools. It's driving the growth of mobile banking and e-payments, and it's significantly reducing transaction costs for financial services, customers, and providers alike. All of this and more is what we're planning to explore and unpack in the upcoming hour. Following today's panel will be this week's Startup Showcase that will feature the company Pay Theory. I encourage everyone to participate and stay tuned. I promise today's discussion won't take too long. It won't go into 13 innings or 4 quarters in overtime. I think Cincinnati should really appreciate that. But we're very excited to be with everyone today. So let's go ahead and get started. The best way for us to kick this off is let's go around the horn and have everyone on today's panel introduce themselves. Dari, let's go ahead and start with you.
Yeah, hello everyone. I'm Dari Grant. I'm Chief Operating Officer of Solo Funds. Solo is a mobile lending exchange platform that connects lenders and borrowers for more affordable loans up to $1,000. And I'm happy to be here.
David?
Sorry, I'm on mute. I have a t-shirt that says, sorry, I'm on mute. I should have worn it today. Good morning. My name is David Hall. I'm the managing partner of Revolution's Rise of the Rest seed fund. We are a venture capital firm based in Washington, D.C., but are very friendly with Cincinnati. Cincinnati was one of the stops on our very first Rise of the Rest tour back in 2015, where we engage with all the economic and entrepreneurial stakeholders in a given community to really help advocate for early stage venture and early stage startups. We invest across, we're generalist investors, so we invest across the industry landscape. I focus a lot on our fintech practice at the firm, but we are really thrilled to be able to back over 150 early stage companies throughout the US. And it's great to be here.
Chirag?
Good morning, everyone. Hopefully everybody can hear me and I'm not on mute. But anyway, I'm Chirag Patel. I'm a partner at EY. I run a group called the EY Foundry, which is a corporate venturing group responsible for identifying new markets and new businesses that we can get in through the creation of new businesses that will help drive growth and transformation for EY, but also for our clients. At EY, we focus across all industries, as does the Foundry, and financial services is an area that we've been very successful from a venturing standpoint, given all the transformation that's happening in that industry. So at the Foundry, we've launched a number of businesses that focus on financial services. But my other hat is to work with clients who are trying to do the same. So our clients in financial services who are trying to reinvent themselves, trying to compete more effectively in the market. And we're helping them from a venturing standpoint launch new businesses as well.
Thank you all for that. And last and probably least amongst the group, I'm Matthew Green, and I help lead the M&A and Strategic Venture Capital Department for Western and Southern Financial Group. Here at Western and Southern, we work with a wide range of venture capital firms and startup companies in the fintech and insurtech space, and we're deeply committed to being a leader and a catalyst for innovation that makes our company here in Cincinnati and our industry in general more attractive and more accessible to consumers of all types. Before we get started today, I wanted to mention for all those who are listening in on today's panel, please feel free to submit questions in the Q&A chat at the bottom of your Zoom screen. To begin today, I'll kick it off and open up with a big picture question for everyone on today's panel. And that is, why is fintech better suited than traditional financial services to accelerate financial inclusion across the country and around the world? David, let's go ahead and start with you.
Yeah, sure. I think it's become really obvious why fintech is leading in this charge. It's just that, I think there are a couple things. I think first, the fintechs that are gaining financing, that are starting to hit some of their growth strides, are able to be a lot more flexible and responsive to whatever the customer, the end customer need is. For example, when back in the day, a couple of years ago, when commercial banks were slowing a lot of their lending, the onslaught of things like Cabbage and On Deck and some of these other lenders came and sort of filled that gap in a way that was much more flexible, able to be stood up much quicker, able to leverage data in their decisioning. And so it really helped accelerate the business while a lot of the traditional lenders were pulling back. On the consumer side, there's a ton of opportunities where things like gig workers just don't have a really good suite of financial products that have been tailor-made for them. And it's not necessarily in traditional finance's business or best interest to create those products at the onset. And so fintechs and startups have been able to come in and innovate really quickly on the margins in a way that is accelerating the ability to serve these customers better than what the traditional infrastructure can necessarily sustain.
Dari, any thoughts to add?
Yeah, I totally agree with that. I would definitely say from a fintech's perspective, we're able to kind of look at the pain points that users normally have that traditional banks aren't necessarily able to tackle right on. So for instance, for underbanked individuals, it might be difficult for them to stay within the banking realm or to find or get credit worthiness approval from traditional banks because they don't fall in line with the normal traditional standards of finding someone, credit worthy in order to get a credit card or a first car loan or whatever that might look like for them. I think that's the best part of fintech is that we're able to look at those pain points and kind of find and fine tune those into unique scenarios in order for those individuals to win.
Chirag?
Yeah, I agree with both Dari and David. I think there are a couple of other things here. You think about large financials, any company in any industry, but you think about large financial institutions, they have lots of infrastructure, decades and decades of infrastructure. They have policies that aren't so much consistent with, where the market is going. And they have a culture that is still sort of inward facing. And so I think with fintechs, they recognize that there's an opportunity here, not only to solve those pain points, and they're doing that effectively, but they can be more nimble, as David pointed out, and they can capture their purpose built to solve a specific problem, whereas large financial institutions are trying to solve all kinds of problems at the same time. I think the other piece of it is right now, the incumbent banks, the incumbent financial institutions, they're so busy trying to compete for market share in their existing customer segments that they're missing out on the opportunities that I think these fintechs are recognizing, right? So I'll talk about this a little bit later, but large institutions and large investment banks, national banks are competing for high net worth and ultra high net worth wallet share, and retail banks are trying to compete for the mass affluent, market share, and they're forgetting about this sort of new emerging customer segment that's entering the market, and they're just busy trying to compete with each other. I think therein lies an opportunity for entrepreneurs who are creating new fintechs.
Awesome. Dari, let's go ahead and kick it to you for a question. Solo Fund's business model is based on access for all. You've created a mobile marketplace that makes it incredibly easy and affordable for lenders and borrowers to connect. Why is there a need for this in the marketplace?
Yeah, for sure. So if you think about it, just throwing out some numbers here, there are about 122 million Americans that are living paycheck to paycheck, and 40% of them don't even have $400 in the bank for an emergency cash need. So these are the individuals in which we want to target that we consider unbanked and underbanked individuals. And so from that standpoint, it's really important for us to not leave them out, because they truly are, individuals and users that are credit worthy, but they just don't have the means in order to get that traditional backing. So that's why we created our marketplace, so that we can say, through our Solo score, which is proprietary to us, we can say, hey, Bank of America, Dari's been on our platform for 2 years now. Give her her first car loan, or give her a more favorable interest rate and a credit card. So these are the different, that's why I mentioned before, that's one of the pain points that we saw. So we wanted to tackle and go after that. So just understanding that and knowing that, I think that is the most trickiest, place and to niche and to go into. However, we found that over time, you know, individuals truly do want to be that traditional person, especially since now and how the economy's turning around now. Essentially, like, I feel as though, you know, our underbanked numbers are increasing over alarming rate, and so now it's to the point where as a retailer or as a small business owner or, you know, or as a teacher, you know, where can I go to get the support that I need, and why not just turn to a community bank for that entrance?
Makes sense. And if I can ask a follow-up question to that,
Yeah.
Peer-to-peer lending brings together strangers to help support one another. What have been some surprising learnings you've encountered along the way about lenders and borrowers?
Yeah, that's a good question. So I would definitely say that we've learned that people really do want us to help people. That's the nature of the world nowadays. So everybody wants to see everybody win, and that's why our platform works the way that it works and has been as successful as it has been today. So, you know, we'll get users and lenders on there who we consider our power lenders, and they solely want to, you know, help individuals for, you know, small needs. It doesn't even have to be anything like astronomical, like, hey, I need, you know, to finish my student loans or whatever that might look like. It can be something as small as, hey, I need $20 to get to work this week. So just like those small things and just having that compassion and those strings is what we find very different, and it kind of shocked us as well too.
Great, very insightful. David, I'll kick it over to you for a question. You see startups from across the country while building a pipeline for your Rise of the Rest fund. What other areas within fintech have you seen peer-to-peer models developing with some level of success?
Well, I'll start that answer, Matt, just talking a little bit so the whole essence of peer-to-peer is unbundling the need on the one end for large balance sheets and large sums of capital, and then the other end sort of finding pockets of demand which are unmet by traditional institutions, right? And so the P in the peer-to-peer, the P2P, can also be really big institutions and really larger entities than just an individual or an individual lender. We're seeing innovations on the fintech side. We're seeing innovations on the insurtech side, where there are insurers who are investors who are looking for the ability to take smaller insurance risks, and so they're able to sort of stand up a P2P insurance sharing program. We're seeing it obviously in businesses like Fundrise on the real estate side, where people are looking for ways to invest in larger categories of real estate. But one I'd love to point out is from one of our portfolio companies. It's a company called Shearshare. They operate a sort of peer-to-peer marketplace, or a marketplace for salon owners and barbers to rent out like a chair or an area of their store. And these businesses, if you're a barber or a stylist, you're the smallest of SMBs, but you don't have a lot of tools available for you. And so one of the things that Shearshare is finding more and more is they're able to leverage this peer-to-peer marketplace to provide financial services, to barbers, to salon owners, to stylists, who frankly, they operate mostly in cash business and don't have the suite of enterprise resources that a lot of businesses do. So I think that the application of peer-to-peer services as it relates to fintech is really starting to get diversified and starting to hit lots of corners of the American economy, of the global economy, in fact.
And to follow that up, do you see a way for traditional financial services to embrace these new peer-to-peer models?
Absolutely. I mean, I think the one thing that you're seeing more and more now is partnership. You're seeing a lot of traditional incumbents partner with fintechs, both for a way to understand how sort of David can help Goliath as opposed to always have to fight Goliath. But more importantly, you're seeing sort of the support of the innovation and the ability for sort of the large incumbent to leverage some of its resources on the regulatory side, on the ability to test across large global populations to really help encourage the innovation that the fintechs are often starting. And so I think that through really meaningful partnership, through some, direct equity investing or debt investing in some of these startups, you're starting to see the support more and more support for innovation within sort of large traditional financial institutions.
That's great. And then continuing with that theme, Chirag, you have a quotation on your website that I wanted to share with the group, and that is, "The complacency that ensues from having seemingly loyal customers, partners, suppliers, shareholders, and employees is often the cause of disruption." What do you believe are the biggest forms of complacency in traditional financial services that are driving fintech disruption around this idea of greater financial wellness?
Yeah, I can't take credit for that quote, but I love that quote, and I can't remember who actually said it, so I apologize. It's just an awesome quote. Let me start by a thesis that we've operated under for many years, both at EY as I run the Foundry, but also prior to that at High Note Foundry, which is my venture services firm, which is around a theme called what we call the consumerization effect, right? Which is essentially the power is shifted away from the institution to the consumer. And we've seen that happen across industries. So we've seen it in healthcare, where patients are requiring better healthcare and they're on-demand healthcare, which didn't exist before. In media and entertainment, we're seeing the same thing. Consumers are really have the choice now. They're not, unbundling of cable is a great example of that. And we're seeing the same thing in financial services. And so as consumers become more empowered, I think that the incumbent financial institutions are going to have to respond to that. Consumers have more choice than ever. We laugh about it, but the reality is things like TikTok and Twitter and all, they're not going away no matter what you say. Now they might get regulated and they might get, there may be restrictions around what they do, but the consumer demand is so high for those types of services, the regulators and the institutions are going to have to respond. It's not the other way around. I think banks in particular have always had this notion of, owning the customer, right, in quotes. And the reality is they don't own the customer anymore. And it's becoming harder and harder to own the customer because the switching costs are so low, right? And most people who own or have a relationship with a financial institution typically have more than one. And even myself, who has been loyal to a particular financial institution, has got more than one financial relationship. And just by nature of who I am, I'm also, working with young fintechs, right? I spend a lot of time with young fintechs. And I think there's this emerging demographic, the younger demographic, who's going to inherit trillions of dollars of wealth in the next 10, 15 years. There is no loyalty to brands. In fact, they don't like established brands. They like emerging brands and new brands and innovative things, right? You see that in fashion all the time. You're seeing that in banking. So this idea of the bank and the financial institution owning the customer no longer exists.
So what can corporations do better to meet the needs of those who have been underbanked or underinsured?
Yeah, I think there's three things, right? And I think David touched on one of them. But from a banking standpoint, I think that the financial institutions, we need to recognize, and specifically when you talk about the underbanked, and we're seeing it around the world. We're seeing it in Latin America. We're seeing it in Europe. Not as much in the U.S. as I think we'd all like to see. But I think financial institutions have to recognize that you can actually make money with lower income households. I know that's a tough pill for some to swallow, but the reality is the banks are there to make money. And they're busy chasing wallet share and assets under management from their traditional market segments. But with technology, there's new and interesting ways to actually make this a profitable relationship for both the consumer and the financial institution. I think the second thing the banks need to do that they're still not doing is to move away from being purely a product pusher, right? And we laugh about it. We say, well, a credit card is a credit card. A mortgage is a mortgage is a mortgage. An auto loan is an auto loan is an auto loan, no matter you bank with bank A or bank B or bank C, and you're just competing on rates. So I think what the banks need to do is start thinking about the consumer first and starting to understand the consumer need and tailor their financial services towards that consumer based on the consumer's life event. And so those are things that at the Foundry, we've actually launched a financial wellness business that actually called EY Navigate that actually does just that. So we really get underneath who the consumer is. We understand that they're about to have a baby and therefore, there's an insurance need, perhaps, I'm just making this up, or that they're looking for to buy their first home. And so maybe there's an opportunity here for us to promote, mortgage products. But the banks don't do that. Today, the banks, if you log on to an online website for a traditional bank. All the services that they provide are the same services, no matter who you are, no matter what the demographic is. And the last thing I think they can do better is to move away from the not invented here syndrome. Banks are notorious, again, I'm talking about the large institutions, are notorious for, you know, if it wasn't built here, it's probably not any good. And the reality is the banks should be competing on customer loyalty and customer relationship, not on building everything themselves and competing around technology. And that's where that partnership, this point that David made is important, is can these financial institutions create an ecosystem of partners with fintechs that could actually create more holistic value for their consumers?
Awesome, good stuff. I just got a question in from the audience that I thought would be good to share with the panel. And that's, with many fintechs saying traditional credit scores are inadequate and finding ways to assess risk differently, how are traditional banks responding? And do you believe the computation of credit scores will be different to adjust accordingly? Anyone want to take that?
I can just do a quick anecdotal thing. I'm trying to refinance my house right now, and I'm having all sorts of challenges. And I won't mention the bank's name, but it's painful. The credit agencies don't necessarily keep up with who I am and my actual real-time credit score. The factors they use are still questionable, right? They're sort of old school and outdated. And the banks, I think, are trying to do better, but they're doing it through disclaimers. So they're saying, Chirag, we want to know that you are an Asian Indian, but we promise we're not going to use that information against you in your loan agreement, right? In your loan processing. So I think there's a lot of work to be done in that area, particularly with the credit agencies, to do better at recognizing they need to innovate around who I am and providing a more accurate reading of my credit score, which is broken today. And two, they need to think about new factors. And I think Dari pointed this out. What are the factors that they want to incorporate into these credit ratings that will provide a much more access to financial services to those who traditionally wouldn't have received it?
Yeah, definitely. Just to piggyback off of that, just thinking about everyday Americans, you know, some don't have credit scores today, and just because they don't fall up under that normal traditional realm of how you clarify as, you know, getting a FICO score, it's very difficult to show how creditworthy individuals are, or even establish or get that credit score that will give you, you know, access to a home or a car or a credit card. I think that's where the lack is as well too. Along with just understanding, you know, because they don't necessarily, well, for underbanked individuals particularly, they don't necessarily use the go to a bank and pay their bills through a bank. They more so pay it in cash or through a money order, or you can't necessarily show the track record, so you can't get a credit score or understand how well you can pay back things in order for you to get, you know, a larger sum or a credit card, as mentioned before. So I think that's a huge hurdle for the everyday American.
Yeah, I'll just really quickly weigh in, because I think what as has been said before, like, thin credit files are just anathema. You can't buy a house, you can't rent a car, you can't even some places get like cable or internet turned on if you don't have like a good credit score. And I think that the data exists today to look at a lot of different factors that can speak to a person's credit worthiness, a person's viability. And I think particularly for underbanked, particularly for new immigrants, particularly for divorcees or widows who you know, for whom a lot of the credit was held in their spouse's name, like that means like a really hard time. And these are all very productive people. They just have had, you know, and I think that traditional banks, traditional financial institutions, it's really incumbent on them, and they're real good customers that are being left behind because of sort of their status. And I think it's incumbent on them, or the fintechs who will be able to figure this out, to serve this community and really over-index in listening to the needs of this community and provide the right products and services for them.
Awesome. So there's obviously a lot of capital flowing into fintech and a growing demand for fintech services and tools. but there are also some big barriers that established and startup companies alike are going to have to get past in order to keep growing. And those can be security and trust issues, compliance and regulatory complexity, removing bias from AI, and others. Which barriers do you feel are the most significant, and particularly when it comes to serving financial excluded populations, which of those do you think needs to be addressed? David, let's go ahead and kick it off to you.
Yeah, as opposed to talking about the specific regulatory issue, I think it's that the regulation is occurring in silos that really starts to affect this. And it's, all of the there's so many different agencies that regulate so many of the different financial products. From your 401k is different from your trading account, is different from your checking account. And so as we think about, building products that can sort of help, and we as consumers don't really think that differently about all of it. I've got my savings, I've got my spending, I've got my investing. Those are the activities, but we think about it because we get one paycheck typically, and we've got to divvy that paycheck up across those different sort of views of our life. And I think, one of our portfolio companies, a company called Rise Money, has built this really slick solution that allows all of those back office issues to be handled from a regulatory perspective consistently, but the front office looks like a single account, which is what people really want to think about. And I think that simplifying the regulatory regime to enable a very, Chirag spoke about this, a more consumerized view of financial services would be a really big step in the right direction for traditional banks and traditional financial institutions to help accelerate that innovation, because it's just so hard to manage all of your different accounts. It takes the average person hours to go through and just get an update on sort of where they are financially, and it just doesn't make sense that it's so hard.
Chirag, would you agree then? Are there other barriers that are particularly difficult?
Yeah, I totally agree with David. I think, the regulatory environment that we live in today is a one size fits all kind of regime, right? And so they don't factor into their regulation, the underbanked or the markets, right? But I think technology, just to kind of switch it a little bit, the technology I think is something that is forcing change at a pace that I haven't seen. On 30 years, I've been building and launching technology and businesses. And right now, the pace of change is pretty dramatic. And you think about AI, you mentioned AI, and you think about blockchain technologies. Those, when they finally do become more pervasive, I think they're fundamentally going to force, again, back to that consumerization effect. This is like the technology effect. They're fundamentally going to force companies to think differently about how they operate. And without getting into my philosophy on blockchain and what impact it's going to have on financial institutions, I think AI is an interesting one. We look at startups all the time at the Foundry, and there isn't a single startup we've looked at in the last couple of years that doesn't already have some AI built into their platform or their technology. Whereas if you look at the traditional banking systems, they're afraid of AI. So I think the opportunity for fintechs is that, starting with the segment of the market that they want, let's say it's the underbanked, since AI systems typically learn from pre-existing data sets, fintechs have a unique opportunity of capturing customer data sets that the traditional incumbent banks don't have. And so that gives them an opportunity to tailor products and services for those underserved markets. Whereas the traditional banks have data from existing customer segments, which they can't train to learn how to service a client that perhaps traditionally they would not have serviced.
I would agree completely with you, Chirag. So financial exclusion affects some populations disproportionately. What are the biggest gaps that you think our industry should be working hardest to close, and how do you believe fintech can continue to evolve as a way of closing these gaps for good? Dari, I'll toss this one over to you.
Yeah, not to be redundant with it, but I definitely think the biggest gap for that I've seen is just the credit piece of it. I think that is something that's really challenging for underbanked consumers to kind of hurdle over. just because of, as I mentioned before, that, they come into a situation with only a certain amount of funds to make it by, but they still have the fees and, have to, circum, either overdraft fees or just the fees of keeping an account open. So I think that's where, where fintech companies like Chime and Simple have come in and been innovative in those areas in order to support individuals. I think that's one of the gaps that that I've also seen. Another gap I would say traditionally would be just where individuals are just able to from a company standpoint, I would say, as you guys mentioned before, just like the different hurdles we had to overcome as far as the regulatory piece of it. So that's why it's very important for us as fintech companies who are in the startup world to be innovative and think of creative ways and challenge those traditional banks to understand and see that, consumers aren't moving the way that they've moved in the past years. We're moving in a different way, in a different trend, and consumers are, adapting to different things. And so let's be open and innovative to those aspects as well. So that's what I think from a consumer standpoint and from a fintech business standpoint.
David or Chirag, anything to add?
Yeah, I'll jump in. Look, I think that we're living in a world, as Chirag has intimated, that is moving at the speed of light, but yet it still takes me 24 hours to send a wire transfer. And I think that you're seeing the ability of businesses like Venmo and PayPal be able to really accelerate some of this disruption, because they're giving, it's kind of silly that, everybody knows, like, both end nodes knows exactly how much is in the account, but it still takes 24 hours for the process to move. And so as I think about ways that fintechs can step up and sort of really lead or how incumbents can sort of think about this, it's really thinking more on, where are there places that they can take a little bit of a risk, right? It's where are there places where they can step in and borrow or buy some of this technological advancement, because it'll help them serve their core customers. And then, like, for example, on a commercial customer, it's still crazy to me that, like, commercial lending, like, is so slow, but yet we saw with the events of the last couple of months how traditional banks and financial institutions were able to open the coffers and push that capital out. So the notion that it's not able to be done is it falls a little short with me. So I do think that there is innovation that's got to happen, and I think it's really happening quickly. And I think that the fintechs are still leading the way. I believe that traditional institutions are leaning more into it, but I think that we've got a ways to go.
So when we think about fintech, our minds naturally go to the most advanced digital technologies, but in parts of the world where financial inclusion is needed most, there's still not a sufficient digital infrastructure. Over half the world's population remains unconnected to the web, for example. What's the role of fintech in serving these people, and are there startups that you've seen that are leading the way? David or Dari, let's start with either of you.
Yeah. So I would kind of beg to differ with that question a little bit, because if I'm looking at individuals from our platform and our target audience, they always have like a phone. Everybody has a phone nowadays. If you don't have a phone, I don't know where you're living at, but everybody operates off of a mobile device. And then thinking about just 90% of, Americans having a phone, like what about those 73% of us who have actual smartphones? So everybody is able to get on an iPhone or get on an Android device and be able to download an app and use an app in order for them to be successful with the different fintech apps that are coming out. So I would say that from the standpoint of, if I was a fintech in the fintech world, and working off of an app, we don't have any I guess pushback with getting users in that individual world or from a web basis, because everybody is so accessible to this information and to access to the web or to a phone.
Yeah.
Conversely, Chirag, are corporate clients of the Foundry focused on addressing this population?
Yeah, first of all, I think I 100% agree with Dari. I mean, if you look outside of the US in particular, You know, you go to parts of Asia, you go to Africa, all the banking is done on a phone, on a cell phone, right? It's not done. Most people don't have computers, but they have a phone, and banking services are being provided by the largest financial institutions in parts of the world that historically didn't have access to banking services, right? Certainly Africa is a great case study in parts of Africa, right? Kenya and other places like that, where small business owners who typically dealt with cash, there was a lot of corruption, and they took out the corruption by actually providing bank accounts to this underserved population using a cell phone. And then you think about you know, Europe and Latin America, who I think are a lot further ahead than the U.S. when it comes to digital banks and what they call neobanks, right? All banking's done online, and so I think the U.S. financial institutions could probably learn from those markets as to where consumers' needs are and where the consumer is going. It's going to happen here as well, especially around generational shifts. But I think, you know, even though all these U.S. financial institutions are interested in focusing on that market, as I said earlier, they're so busy today competing with each other, right? And that's where the opportunity lies for fintechs. They're so busy competing with each other and for assets under management, wallet share. So you think about the retail banks, the regional banks are trying to grow market share in their local markets and compete with the national banks. They're all trying to move upstream and try to go after the high net worth and ultra high net worth segments. And those large institutions and investment banks who made a lot of money on ultra high net worth and high net worth are moving downstream and going after the mass affluent and the retail banks using robo-advisors and things of that nature. They're excluding that emerging market that I think we're all trying to talk about here. And I think that if I were running a financial institution today, one of my bets would be that in the next 3, 4, 5 years, I'd be investing in that market from a pure digital neobank standpoint.
Makes sense. We got some good questions coming in from the audience So this one is in regards to regulation. And they're asking, one of the realities of the financial services industry is that it is heavily regulated. Can you speak to the role of government in supporting innovation that supports unbanked or underbanked consumers, and what challenges or opportunities does this provide for fintech specifically?
I'll jump in there. I mean, look, I think that one of the main charges of the government is to make sure that individual consumers who don't have the financial sophistication to understand the ebbs and flows of a lot of the market dynamics have layers of protection to make sure that their hard-earned dollar, you know, is still there when they need it and hasn't been sort of usurped by somebody with fraudulent claims or whatever. And I think that there's still going to be a role for that. I guess my perspective, and I talked about this a little bit earlier, is how can we think about ways to streamline this? How can we think about ways to remove a lot of the sort of the redundancy that not redundancy in regulation that has to happen on a daily, monthly, quarterly, annual basis at every financial institution, that fintechs are frankly enabled and have been sort of, I don't want to say skipping the line, but definitely sort of smoothing out some of those rough regulatory edges or sharp regulatory edges. And I think that it's it's the government's interest to continually stay up to date with the latest happenings in around the world as it relates to new financial products that are coming to market, and figure out the best, lightest way to regulate them so that they can really serve particularly some of these critical needs, like the underbanked, like startup small businesses that are really struggling to find products without the heavy encumbrance of regulation.
Shrag or Dari, anything to add?
Yeah, I mean, I would agree with David. I think they're not doing enough. I'll just add to that. I don't think they're doing enough. I don't think they recognize, again, it's sort of a one-size-fits-all regulatory environment that we live in. And I think, their constituents that they typically respond to are not necessarily always the consumer. They're typically the institution. And so, again, back to that consumerization theme, our regulatory environment, regardless of whether it's a Democrat or a Republican, in power, is used to, responding to the large financial institutions who want to increase or decrease regulation based on their specific financial, objectives. I think what's going to happen in the future, and it's already starting to happen, is the consumer is starting to influence regulation in ways that we haven't seen before. So back to that sort of silly but important example, TikTok, even if the acquisition of TikTok happens here in the US, what are those two companies who are looking to acquire or invest in TikTok going to do with it? They don't really know. I don't think they know what they're going to do with it, right? Because TikTok, consumers want TikTok, and consumers will use TikTok, and they'll find a way to use TikTok. It's the institutions and the regulators going to have to reinvent or figure out new regulations to manage it. So anyway, I think that we'll see things happening over time, but the consumers are going to have to, push through and influence those changes. It's not going to be the institution.
Makes sense. So we got another question in from the audience here. Do we have too many fintechs trying to solve the same problems? Some examples of this are in Tech Nation, UK, a huge number of fintechs, and in Silicon Valley, a large number of fintechs. Do they need to consolidate, and are they trying to innovate against some of the world's largest companies with amazingly large footprints?
I'll just say two words. The answer is yes, but I don't think it's a bad thing, right? So in the past, I've been an entrepreneur. I've started my own companies, and in the past, I've raised lots of money for these companies. I've always had to, explain to my investors that I was raising money from why what I'm doing is different, and why it's going to be big, and why it's going to compete different, whatever they want to hear. I think today, you see a million payment processing companies out there, and I can't keep track of them. And David, you're probably better at it, because you see more, but I can't keep track of them. There's so many of them. But the good news is there's lots of the exit strategies for these young startups are not what they were when I was doing my startups, where it was an IPO and possibly an exit, right? Now it's really about an exit. It's selling to a financial institution. And so if you're a startup doing a point solution, and think about what your exit strategy is. And I'm not saying build your business towards an exit, but think about what your exit strategy could be. And there's enough buyers out there for your solution. So if there are 3 micro savings, startups out there, there's probably 20 buyers of that point solution if you decide that you wanted to exit your startup. So I don't think it's such a bad thing, but yeah, there are a lot of startups out there trying to do the same thing for sure. At least in my what I see.
Yeah, for us in the lending space, I would say that we have indirect competitors, as we call them, only because we have different niches. So we have the same goal in mind, but different niches and different audiences as well too. So I think that's the beauty of it, is that if you do have someone in the same space as you, it shows that you are in the right space and you are doing the right thing and tackling the right cause and issue as well too. So I think it's all about how fast you can work towards it, how well you can sell it, how well you are able to get the audience that you need, the growth and scale as much as you can as well too.
So I'll answer it a little bit differently. I don't think that there are enough fintechs. I think that there are trillions of dollars spent, trillions of euros spent, trillions of currencies that are exchanged, and there's thousands of financial institutions. And so the idea that there's still innovation that needs to happen in pockets in some of these point solutions, both for consumer banking and consumer financial services, and also business financial services, that still need to work. And I mean, obviously, I'm a venture capitalist. I'm trained to start to say, of course, there should be more startups. But I think that there's more innovation that needs to happen. And the way to drive innovation is by having startups compete to figure out the best solution. And I think that still needs to happen more as both consumers are maturing, as our financial institutions are changing, as questions about access to the financial world and financial institutions are changing. We need businesses that are going to be able to start solving those, to be created to start addressing and solving those problems. And so I think the more that we evolve and accelerate our financial systems and the global connectivity of those systems, the more you're going to see businesses on sort of the money exchange side. We haven't, Chirag hinted at it, but the whole crypto and Bitcoin side, where we're looking at all of these distributed ledger technologies to be able to help manage some of these transactions in the back end, the cash currency versus digital currency and how that's going to change. Like, there's so many new things that are coming down the pipe that I think that there are lots of businesses that need to be formed to at least address how these problems and challenges can be properly and sustainably commercialized.
Got it. I got a question come in relation to how incumbents and startups interact with each other, and that is, can someone talk about the complexities with incumbents around data sharing internally and externally, and how do you see that communication and collaboration improving or changing?
Yeah, so just this is from a large financial, a lot of these financial institutions grew through acquisition. And if you look under the hood of these financial institutions, you notice there's multiple infrastructure or environments set up across the bank, right? There's and not only are they in lots of businesses, but they've also grown through acquisition. And so I think these financial institutions are trying to do better at integrating these systems and these data sets, but from what I've seen, there's still a lot of work to be done there, right? I mean, I started my career in financial services, and one of the biggest problems that I learned at the company I worked for was they were trying to build a single customer database. Now, you would think to yourself, well, that's got to be pretty simple. Like, how hard can that be, right? 30 years later, I'm consulting to large financial institutions, and guess what they're talking about? Building a single customer database. So, they're just not very good at it, or they haven't figured it out, or maybe things keep changing. And so sharing of data is a problem inside of large financial institutions. In terms of how these financial institutions interact with, or any large company interacts with startups, I think there are some that do it well and some that don't. My group at the Foundry, that was one of my concerns when I became part of the EY Foundry, and I run this corporate venturing group within EY. Is EY such a big organization? We're 300,000-400,000 people globally. In many ways, we have our set ways and our infrastructure, and we're like any other big institution that needs to transform and grow and whatnot. So I was nervous that, am I going to be able to be successful in an environment like this where I have to act like a startup, but I also have to interact with the startups? And I think we figured out how to do it. We've acquired multiple startups. We're doing alliances and partnerships with startups, but it's not easy because, most startups don't have the bandwidth or the time to get lost in the bureaucracy of a large organization, right? Who do you call when you want to do a pilot or a, partnership with, pick a bank, right? Large bank. They don't even know who to call. So I think some financial institutions and other big companies are getting better at it, and they're all looking to do it. But executing on that is still a challenge. But I would encourage, again, startups to not shy away from large institutions. I think there's a big opportunity there to create partnerships and alliances. And I don't know who said it, Dari or David, that in the future it is going to be more of an ecosystem model that these large institutions try to develop. And that ecosystem is going to be filled with fintechs and younger companies.
David or Dari, any thoughts to add there?
Yeah, look, I think, it's often the moniker that the incumbents are playing not to lose and the startups are playing to win. And the way to get those folks to work together is to find those bridge builders at the incumbents that recognize that their marketplace is changing or shifting, and it's at the very best interest of the company to at least understand, maybe not control or own, but at least understand how the disruption, how the market landscape is shifting. And I think that it is through partnership. It's a cliched word, but partnership and investment to say, we're going to partner with this startup, and we're going to really, and it's incumbent on the institution, the larger incumbent, to not have sort of the bug in the windshield mentality, right? Like not to exert too much pressure on the startup, because like it could overwhelm with just the sheer volume of a lot of these incumbents, but really figure out the best optimal way to help elevate the startup so they can fully understand what that disruption looks like and that innovation looks like at scale. And that's where it starts to get really interesting for a lot of the traditional financial institutions. And I think really looking for sort of internal champions. It obviously all boils down to leadership, and a leadership that can embrace change and wants to sort of be part of the future as opposed to prolong the past. And I think that those, if you can find those leaders and those change agents in these organizations, it'll be really helpful for the startup to have a much easier process of getting the commercial deal or the partnership struck.
All right, final question for the day, and this is one should be very interesting. This is around our current environment. So that is, what impact do you believe the COVID crisis will have on financial services and financial inclusion, specifically as we work our way through the year ahead? And in addition, what are the biggest opportunities for fintech to help us come out of this crisis better and more inclusive than when we were when we went into it? David, we can go ahead and kick it back to you to start.
Thanks. So I would say simply, the first thing that COVID has done is it's been a huge accelerant for innovation. We've had to figure out how to get $5 million worth of stimulus checks, or 5 million stimulus checks into people's hands, and the government had like a print backlog. And it just seems silly to me to still be printing out checks to give to people if the idea is to get them money urgently when they're, everybody's got a debit card that's linked to something with zeros and ones, not necessarily linked to something with cash currency in the back end. So I think really figuring out how we can be unbundled by or unburdened by the physical infrastructure of our sort of economy. I think the second thing is how we can think about sort of just thinking past our legacy. So should this startup or should this brand be able to be the financial institution of choice as opposed to having the local corner community bank, and being thoughtful that people want to bank with the brands that resonate most with them. And I think that you'll start to see the rise of these fintech power brands. You're seeing it with businesses like Chime and solo funds, where there are people that are voting with their dollars that say these are the institutions that most represent me. And I think it's a really interesting thing that COVID is accelerating the use of these startups in like traditional financial services transactions all the time.
Yeah.
Dari, any response to that?
Yeah, I was going to say, I totally agree with you, David, on that. I think it's very important for, as we, move forward and navigate through this, that, traditional banks, the partnerships between traditional banks and fintechs is key pretty much in order for, individuals to win and be successful from both traditional side and from a fintech side. Just understanding that, things aren't necessarily going to be the same. And if a traditional bank can see and understand, their gaps and their loopholes and feel that with a fintech company, I think that would be, beneficial for the companies as well as the individuals as well too, as we navigate through this tricky time.
Yeah.
Rog, any final thoughts?
Yeah. So I will just sort of echo both statements, and I'll try to summarize this from my standpoint. I think COVID is training consumers and institutions to go digital. Like they have no choice, right? And you're seeing it, to my earlier point, around consumerization in healthcare, right? It was people that were afraid to actually go to a doctor via their FaceTime or whatever. Now they're doing it, and now insurance is paying for it, and so on and so on. So I think what's happened is institutions are going to have to figure out, or have to accelerate trying to figure out how where they can't hide inside their bricks and mortar stores. They're going to have to go digital, and they're going to have to do it in new and interesting ways to proliferate their brand. And consumers who are shy about engaging financial institutions on their mobile device or online are not now being forced to do that. So there's a behavioral shift that's happening that's, I think, going to, as David said, accelerate the adoption of technology and digital and all the things that we've been talking about throughout this morning here.
Awesome, great insights, and I'd especially like to thank all of the participants in today's panel, especially the Centrifuge team for putting this together. The FinTech Frontier panels have been extremely insightful and should really help drive FinTech forward in the greater Cincinnati area. So I appreciate everyone's time today and participation. And with that, Pete, I'll hand it back over to you.
Great. Thanks so much, Matt. Great job moderating. And thanks so much to our panelists. Fantastic discussion. I was scrambling trying to come up with the best tweets, and we're going to try to keep this, preserve this conversation and keep it going. We wanted to, before we close, we wanted to turn to this week's Startup Showcase star, Pay Theory, and Brad Howeller, who is Pay Theory's founder and co-CEO, will tell you more about their mission, which I'm really, really inspired by. But let me start off by telling you a little bit more about Brad. He's the quintessential serial entrepreneur. He spent 12 years as a founder and CEO of Skipjack, which was one of the first internet payment gateways. They exited that venture, and Brad went on to found Argo Labs, another payment and fintech venture. But of all these ventures, Pay Theory is one that I believe is truly changing the world for the better and making one critical aspect of fintech more inclusive and accessible than it's ever been. So on that note, I'll hand it over to Brad. Take it from here.
Thanks, Pete. I just wanted to first say this is a great panel. I thought everybody, touched on a lot of great points. I wanted to thank you and Centrifuge for allowing me to say a little bit about Pay Theory, and that was a fantastic intro. So with that, I'm going to share my screen. I'm not going to go through our deck the way that I normally might, but what I would like to do is really focus on some of the themes that we've spoken about today. So as Pete mentioned, I've got a pretty extensive background in the payment space. Hopefully, Shrug, I'm not one of those many payment companies that you see. I was lucky enough to meet my co-founder, Eric Folkert. We were discussing some vertical SaaS plus payments opportunities. He was in the ed tech space, and we really got interested in some of the problems that we thought existed in that ed tech, family tech space. And as a result, we created Pay Theory. And so let me see if I'm having a little trouble here. I'm getting to my screen. I might need a little bit of help from the crew here. Thank you. So as I mentioned, Pay Theory is a payments platform for family tech. What Eric and I really focused in on as we were exploring the space is the concept that money equals access, and financial services, of course, are about growing and managing money, so it can be used to gain access to things that people want. And fintech is the application of technology to make that happen. I think you heard in the panel, there are a lot of incredible trends that are going on in the fintech space, whether it's digitization of payments, the focus on specific verticals, the individualization of financial products. And while all those are really exciting, what we're seeing is that at times, though, they tend to also create barriers to access, and especially in certain key verticals. As we mentioned, we're very much focused here on family tech, and in that kind of a space, those kind of moves can actually cause certain portions of the stakeholder groups here to lose access to those financial services. So what we are trying to do is create products that both take advantage of that increasing digitization, smoothing out problems for our stakeholder groups, so schools on one side, or family care providers that could be doing things like adding additional information collection, accounting integrations, and providing the payment services that the families that they're servicing need. So I know that we mentioned, one of those trends was the digitization of payments. As the panel mentioned, COVID really is accelerating that trend, as we all know. Square has said that prior to COVID on March 1st, about 8% of US sellers identified as being cashless. And as quickly as April 23rd, that number jumped to 31%. But what does that mean? When we look at the family space, 30% of families with school-age children are in the on or underbanked category, which means that if we move to a completely digital form of payment, we're leaving that group behind. Those families that either want to or need to use cash to make the must-pay expenses that they face on a daily basis. And so you have a number of conflicting trends going on here. And, you know, we've mentioned that 40% of families are living paycheck to paycheck. Dari mentioned 122 million Americans who fall into that category. So what Eric and I saw is that it was very important not only to enable these payments and help schools and families connect, but also we needed to do that while keeping access for those families that can't come along as quickly as we all might like. So what does a solution like that look like? Well, number one, it has to accept cash. And for the schools, what I'm using air quotes over on my side of the screen here, you know, that has to be a cashless program for schools while still allowing families to pay with cash. It has to provide for access to fairly priced credit products. It should provide valuable rewards for making these payments. And it should play nicely with the service providers, so the schools in this case, legacy systems that often lag behind technologically. Finally, and this is the screen that we're looking at now, it also has to work very seamlessly with the hundreds, thousands of SaaS platforms who are rising up to serve as the relationship managers between those vital service providers, the family tech service providers, and you know, the education space, family care, healthcare, and the families that they service. So this really has coalesced into our product mission to make it more possible for families to make the must-pay, the vital expenses to keep their access flowing. So, and we also are, you know, we're doing this for the families, we're doing this for the service providers, and we're doing this for the SaaS platforms that are bringing those two groups together. The outcome, better access for all. Our platform incentivizes players to participate at all levels. So for families, cash payers can pay in cash electronically just by getting a unique barcode during the checkout process from us, going to one of our over 30,000 plus retail store partners where they actually pay in cash. We then, with our partners, handle the movement of the cash back to the school or the service provider. And because we have access and we see the bills that the families are paying, you know, we're getting a lot of that data that Dari and David talked about, where we can, you know, have access to some of those transactions that might not have been accessible to other credit reporting offerings. For the service providers, we're looking at helping them solve a lot of problems that revolve around the you know, the fragmentation of the services that they need to provide. You know, these are typically institutions that are not great at handling their fintech needs, right? I mean, that's not why they exist. They exist to provide education to our families, childcare to our children. And we do this with an open system so that you know, it can work with any tech stack that the service provider might need. And of course, with the vendors, with the SaaS platforms that are trying to solve a lot of these needs, we then provide them with the ability to benefit from the revenue that's crossing their platforms. Some cases, these providers are not taking advantage of that revenue stream. And by being the experts on the payment side of this, adding a lot of value that's specific to the family tech space, we're able to allow them to participate in that revenue stream. And what that means is that we're delivering a better payment experience for all parties involved. And so what that means at the end of the day is that pay theory is providing access to families, the service providers who are servicing those families, and the SaaS platforms who are helping to make those connections. And we think about our success as one where by doing all this, we're focused on making dreams happen. That might be a little over the top, but really that's what at the end of the day, we view as success for us and our partners and all of our stakeholders in this, is that by providing access to the services, making sure that families aren't left behind, while still allowing the SaaS platforms and the service providers to take advantage of these increasingly powerful fintech tools and payments tools. That is really our goal here. So I apologize for not being able to run through this deck as quickly as we would like, but what I would love to be able to do here is if there are any questions, we can go through those. I really appreciate the opportunity to kind of talk about how we are trying to tackle the problem of access for families.
Thanks so much for that. That was a great presentation. Looks like a really promising startup play. And unless there's any final questions or comments based on the presentation, I will wrap up our session. And let me just thank everybody for being here. We had a fantastic crowd. I think our biggest crowd ever. And I think we actually had quite a few folks from outside of Cincinnati, which is part of our goal because we're trying to build a big movement here. But I wanted to give you a heads up that our next conversation is October 15th, where we will explore more of the fantastic fintech innovation emerging from inside of the coast. And so the Midwest and Cincinnati in particular is tremendously well suited for the future of fintech. And I think we got a good feel for that today. We'll hear from investors, builders, and founders. So please join us by visiting fintechfrontier.com. We're going to try to build a real brand around that. And lastly, I wanted to make sure that we note that the biggest event of our Fintech Frontier schedule is on October 29th. That is our Fintech Pitch Competition. Applications are open through the middle of October, and we got some awesome surprises. I mean, prizes, maybe surprises too, but over $60,000 in prizes. And again, that is kind of coming from our leading financial institutions. It's our way of saying that we are putting our money where our mouth is, real skin in the game. So let the word go forth to entrepreneurs out there. Even if you're in a big company and you're side hustling a big idea, or you're an entrepreneur who has an idea, we want to hear from you. We're eager to host you in Cincinnati. We want to do everything we can to not only create the #1 startup hub in the Midwest, but the #1 fintech hub in the Midwest and the top fintech innovation center. So thanks again to everyone for participating. Let's keep the conversation alive on Twitter, and we hope to see all of you very, very soon. Thank you.